I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer, specializing in strategies. And you better have one because I'm looking at things falling apart really quickly. And I think it's really interesting. I feel like I don't exactly feel like we're in the eye of the storm because there's so many negative things that are happening, but people have put their blinders on and it's like they're 2 years old. Oh, you can't see me because I have my hands in front of my eyes. I mean, that doesn't make any sense. So look at clearly what is happening because this is a global economy. And ultimately, they want it to get even more global or under a one world management system. That's another story for another day. But we have to know what's happening in China because it's happening everywhere else too. China's gold binge extends to 7th month. Actually, that was back in June. It is now extended to 10 months. So China is gobbling up gold as quickly as they can. Why do you think they might do that? What is it that they are preparing for? And when I say China, I'm really talking about the government there. What are they preparing for? Because it wasn't all that long ago when the world comes to China. I said at the time that I didn't think that this was a good idea, that in my opinion, and it is still my opinion, that by the MSCI issuing an ETF tied to the Chinese markets, it was about funding the Chinese markets and giving them money. That happened back on May 31st in 2018, and they're going to include that. Whoop-de-doo. And they are including it at a 5% initial rate, could lead to approximately US dollars 22 billion of capital inflows into these stocks. Well, that benefits somebody, but I'm not sure who that really does benefit. A leading provider of global equity indexes, which these things can be created at whim, and all they have is, like garbage. They're made up of garbage. They're not made up of anything that's real. But they announced beginning June 2018, it will include China A shares in the MSCI Emerging Markets Index and the MSCI ACWI Index, all that alphabet soup. So what was the result of that? Well, this graph starts in 2017. Let me grab my laser pointer. And the result of that was a flood of money into the Chinese markets, which is now reversing or has begun to reverse. But quite honestly, it is still at nosebleed levels. Do you think any of this is an accident? And by the way, who do you think owns this stuff? Let's think about this. Maybe retirement funds, maybe pension plans. I would say that a lot of entities that are investing your money into 401ks, wherever, they're the ones that are really supporting this more than anything else. Look at the level of equity ownership in all of these different areas of the MSCI, right? Still at nosebleed levels. So therefore, since you may not realize that you own it, I think that you need to be aware and double check and see if you don't indeed. Because what goes up must come down. And when you do stimulus, right, all of this debt creation and money printing for free, and it doesn't matter where that happens in the world, it makes things look like growth is great. Oh, look at the growth engine in China. Look at the growth engine in the US. So taking on new debt and creating cheap money can make things appear to go up. But number one, every time they do that, the value of the money that's already out there goes down. And number two, it's not sustainable. So here you go. Chinese home prices dropped at fastest pace before fresh stimulus. Oh, wow. But property investment and sales remained weak last month. Oh my gosh. And analysts doubt latest easing measures will end the housing slump. Oh no! So what happens is the more stimulus they issue, it's like pushing on a string. And I don't care whether you're in China or you're in the US, the more stimulus they create, the less impact it has. Now let's look at Chinese property market, because you might be sitting there going, oh, but in the US, there are still pockets where prices are rising. Does that mean that they're in good shape? No, it does not. China's property market is in crisis. Home prices are falling. Developers are defaulting and people are angry. The worry is that a total collapse will bring down an already faltering economy. So why wasn't all that money printing go anywhere in the flippin' world? Why didn't that fix things if it's so stimulating? For goodness sake, you can even look that the home prices fall for the third month. Well, look at propping up home prices makes people feel rich. And when they feel rich, then they'll spend money. They'll take on more debt. And in China, well, look, it's true in the US. We always point fingers, but we got to look in the mirror. I mean, that's where you see the truth. People have been trained to think about houses as short-term investments. It used to be somebody would buy a house, they would have the top of the newel post removable because the newel post would be empty. When they paid off their mortgage, they had a party. They buried the mortgage paid documents inside that newel post and glued that newel post on, glued it on. And then that property was passed down from generation to generation. What's wrong with that? Imagine what it would be not to have a mortgage payment, right? But they want you to think short term. Declines may worsen home buyer sentiment as slowdown persists. Well, yes, it becomes a doom loop, right? So prices are going down. So therefore, what's happening to my money? Therefore, I'm not going to spend it. And remember, China's been transitioning into a consumer-driven economy. But the most recent stimulus resulted in a spurt of home sales in large cities, and that is already losing momentum. So can you see this whole thing really falling apart? And the reality is stimulus is not stimulating, only for a few, and not for you and me, because we're not in that club.